What if the next major bull run has already started forming quietly, while most investors are still focused on headlines and short-term noise? History shows us again and again that the biggest market opportunities appear when confidence is low and clarity is missing. By the time everyone agrees that a new bull market has begun, a large part of the upside is already gone. Today, instead of guessing or following hype, we are using real data, historical patterns, and macro signals to map where the next bull run could begin and why 2026 may surprise many investors. Every major bull market in U.S. history started in uncertainty. In 2009, markets turned higher while fear dominated the financial system. In 2020, stocks began rising when economic data still looked terrible. These moments felt uncomfortable, but they created life-changing opportunities. The reason is simple. Markets move ahead of emotions, ahead of headlines, and even ahead of economic recovery. Smart money positions early, while most people are still waiting for confirmation. This is why opinions don't matter nearly as much as data. Instead of listening to predictions, professional investors study interest rate cycles, liquidity trends, corporate earnings, and institutional capital flows. These signals often shift months before prices make their biggest moves. When multiple data points start aligning, they quietly point toward where capital is preparing to move next. Right now, several of these signals are beginning to line up. One of the most important factors is interest rates. Historically, U.S. equity markets perform best after the Federal Reserve finishes tightening policy. Markets don't wait for rate cuts to begin rallying. In many past cycles, the early phase of a bull run began during a pause in rate hikes, not after dramatic easing. As uncertainty around rates decreases, investors start to look forward again, and risk appetite slowly returns. Liquidity is another critical piece of the puzzle. Markets do not rise on hope alone. They rise on money flowing through the system. When financial conditions begin to ease, even slightly, capital starts moving back into growth assets. Bond market behavior, credit spreads, and money supply trends often improve long before stocks make their strongest moves. Right now, liquidity conditions are quietly stabilizing, which is something most retail investors tend to overlook. Smart money always moves first, and it rarely chases hype. Institutional investors focus on areas with durable cash flow, pricing power, and long-term demand. Data from previous cycles shows that early bull markets often begin in specific sectors before spreading across the entire market. These usually include technology infrastructure, industrial innovation, energy transformation, and parts of the financial system that benefit from economic normalization. These sectors form the foundation of a new cycle. Another powerful signal is sector rotation. During periods of fear, capital hides in defensive areas. But when confidence slowly returns, money rotates into cyclical and growth-oriented sectors. This shift doesn't happen overnight, and it rarely makes headlines. It happens quietly through gradual accumulation. When capital begins flowing toward productivity, innovation, and expansion, it often marks the early stages of a bull market. Earnings growth plays a larger role than most investors realize. Bull runs are not driven by perfect economies. They are driven by improving expectations. Companies with strong balance sheets, stable margins, and the ability to manage costs tend to outperform first. In past cycles, stock prices began rising well before economic data looked strong, simply because future earnings started to look better. When we combine all these elements, interest rate stabilization, improving liquidity, institutional accumulation, sector rotation, and earnings resilience, we can build an opportunity map for 2026. This map does not rely on predicting exact dates or market bottoms. Instead, it highlights where capital is likely to flow as confidence gradually returns. The biggest gains historically come from positioning early, not chasing momentum later. Most investors will make the same mistakes they always do. They will wait for headlines to turn positive. They will wait for analysts to upgrade their outlook. They will wait until prices are already higher and risk is greater. By the time investing feels safe, the opportunity is usually gone. Data-driven investing requires patience, discipline, and the ability to act when things feel uncertain but logical. Smart investors are not trying to time the market perfectly. They are preparing. They are researching quality companies, understanding long-term themes, managing risk, and building watch lists before excitement returns. Preparation is what separates those who react from those who lead. If history repeats, the next bull run will not begin when everything looks perfect. It will begin when uncertainty still exists, but data quietly improves beneath the surface. That is the environment forming now. The real question is not whether opportunities will appear, but whether you will recognize them early enough to act. If you found value in this data-driven breakdown, make sure to like the video, subscribe for more US market insights, and stay ahead of the crowd. Because smart money always moves before the headlines do.